Comments made on the following paid commercial program are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time.
Welcome to the Money and Wealth Show. On the program this week, tax tips with David Ingram, money commercials, and our special guest, John Mauldin. Welcome to the Money and Wealth Show. I'm Sterling Fox, and today our special guest is the president of Millennium Wave Investments, joining us from Dallas, Texas, John Mauldin. Welcome to the program.
Well, thank you for having me. It's always fun to be here.
Well, it's good to have you, and you're a very interesting guy. You edit Thoughts from the Front Line, which is available on the internet to any and all who'd like to go and look. You've got a new book coming out. We'll talk about that in just a little bit. But you've also focused extensively on something called the debt supercycle. What is that, John?
In the U.S. and in much of the developed world, in the 50s, when we'd borrow $1, we would invest it, we would put it into businesses, we would increase productivity. So basically $1 of leverage got us, $1 of GDP growth.
Okay.
And over time we decided that it was kind of a good thing to borrow money to improve our lifestyles, to fund governments, to run deficits, and the debt to GDP, total between private and business and government continued to rise. Towards the end of this last crisis, we were borrowing $3 to get $1. I mean, it wasn't as productive, mostly because we were borrowing money to buy stuff to put in our houses. Our houses became ATMs.
Was government leading the parade, even though you're talking about individuals and our descent into multiple debt loads? Were governments at the head of the parade?
Sometimes, yes, depending on the government. I mean, Japan certainly has been borrowing huge amounts of money and taking the savings of their people to fund it. The Greeks were clearly leading the way with their, once they had the chance to borrow money at German rates. The line is that the Mediterranean countries got German bond rates and Germany got a Mediterranean currency. Mm-hmm. What happens is there's a limit to how much money you can borrow. And Greece obviously is the case in point now that everybody talks about. But there's a limit to how much the U.S. can borrow, how much Spain and Japan and a number of developed countries are beginning to recognize that they too could become Greece if they don't do something. So they've got to begin to pull back. And that deleveraging, just what individuals are doing, and the reduction of those deficits creates a fundamentally different economic climate than what we've had for the past 60 years. And this deleveraging post-debt crisis cycle could take anywhere from 6 to 8 years to work out.
Okay.
So and that's a slow growth, muddled through, more volatile markets.
Let me pull you back to Greece for a second,
Okay.
John. Greece, serious debt issues.
Mm-hmm.
Should Greece, being as utterly incapable of addressing their debt issues, been allowed to go bust? Should they have been allowed to default and flatline?
Well, I think Greece probably should have chosen to do that. In essence, what we're doing is the ECB is lending more money to Greece so that when they eventually do default, it'll be from a bigger pile. Now, what I believe is happening, is that the ECB, along with IMF, which means U.S. and Canadian taxpayer money, is buying that debt from Greek banks. I mean, from European banks, so that the banks won't end up having to have another credit crisis. In essence, we're bailing out European banks, and at the point when this ends, Greece will still be a problem.
Yes.
And they'll still have to default. I mean, it's not like they haven't been in default for 150 out of the last 200 years. I mean, this is not a new condition.
Correct.
So I mean, they're just going to, I mean, at some point you just have to let them pick up their own pieces.
Is there an inevitability to all of this? Because you said just a moment ago that Greece, and I'm paraphrasing, will collapse at some point down the road.
Well, see, here's the problem. If you do what the IMF and the ECB want, if you reduce your fiscal deficit by 4% a year, that means you've either got to reduce spending or you've got to increase your taxes by some combination. That's an immediate 4% hit to GDP. You've just said you throw yourself into a recession. I mean, it would be as if the US came along and said, we want you to cut $600 billion a year out of your government budget. That'd be off the back of my head, 20%. Mm-hmm. Just start cutting it, It's just huge amounts, okay? It's 20% is not right, but it's a large number. Mm-hmm. And I mean, it would throw us into a serious recession. I mean, what we and most countries are going to have to do is take those deficits down a piece at a time, not 4% a year, and then 4% the next year, and then what will be 4% the next year, because they will have reduced their GDP, they will have increased their debt. So then the IMF is going to come and say, you've got to get even more austere, and they don't have a currency that they can allow to go to in half, that allows them, gives them some way to export their way out of the problem. I mean, which is what Great Britain wants to do. Right. Great Britain is going to allow their currency to drop, in my opinion. It could go to parity with the dollar. It could get close to parity with the Canadian dollar. You'll be able to go to London and buy stuff just like, 10 years ago they were coming here and buying your stuff. I mean, it all goes around. But I think the euro's going to drop. The yen's going to drop in value significantly. It's going to become a very, very interesting world as everybody wants to devalue against Canada and the US and other countries so they can sell stuff to us, which of course makes it more difficult for us to export stuff.
It's not a boring time.
No, not a boring
in the history, in the economic history of the world, is it?
No, it is not.
Let me take a quick break here, John, and we'll get back to more. Particularly, you're from Dallas. We'll talk about the U.S. economy and, of course, as it obviously affects Canada so directly. Mm-hmm. John Mauldin is our guest. You're watching the Money and Wealth Show, and we'll be right back.
Good afternoon. My name's Larry Ray. I'm the president and CEO of American Manganese, Inc. I'm here to tell you today that American Manganese could possibly bring in the lowest cost electrolytic manganese metal mine in North America. It'll be the first one in the past few decades. What is manganese? Well, you can't have a steel industry without manganese. If you don't have manganese, you don't have steel. If you don't have steel, the world stops. North America has no manganese. We depend on our neighbors and other countries to import our manganese, and it just doesn't make any sense we don't exploit the resources in our own country. So I'm here to tell you that we are moving ahead with the feasibility study, we're moving ahead with the environmental studies, and we're moving ahead with a massive drill program in order to build the American Manganese, Inc. into the first primary electrolytic manganese producer in the United States. Please visit our website at americanmanganese-inc.com or call us at 604-531-9639. Thank you.